On today's show, we'll look at which investment strategy is perfect for Generation X. So grab yourself a brew and let's begin right now. When we begin to look at Generation X and the best investing strategy for them, age does become a factor. Obviously, it's not as big of a factor as it is with the boomer generation. However, it does still play a role, as we'll see momentarily. For the Generation X, those are people who were born between 1965 and 1980. As of the year 2022, they will range from 42 to 57 years old. So when it comes to investing, a major focus will be on building a balance between passive income and growth investments. And that balance is going to shift over that age range, which we're going to see here in just a moment. So what about the best investment strategy? Well, at age 42, as you're just moving into the Gen X range, we should be looking at about an equal part blue chip dividend stocks to growth ratio. So they should be pretty close. Now you're just coming out of your 30s, you're moving into your 40s, you're not thinking yet about retirement, but as you move through this age range, you will of course be thinking about retirement. As the Gen X move towards where the boomers are now, their strategy needs to shift to match that strategy eventually. So by the time you hit 57, you're looking at a high percentage of blue chip dividend stocks with moderate amount of growth stocks. And this will sort of shift from 42 to 57. You're going to see it start off, well, at 42, it starts off as equal. In many ways, this ratio of blue chip dividend stocks to growth stocks is almost like a spectrum. It begins as an equal partnership around 42, but as you move towards 57, that changes pretty quickly as the dividends become a much more prominent part of your investing portfolio. When it comes to Gen X investing, we need to look at the TFSA and the RRSP as well as taxes. We're going to start with the TFSA. One thing that's great with the TFSA is it's really a great place to be storing your Canadian dividend stocks. And what's interesting too is with Gen X, if you've been investing a long time, you have a good possibility of perhaps being close or at your limit within the TFSA. So your dividend stocks that you have into your TFSA are fantastic because those dividends are going to increase the dividend cap as they grow, because any growth within your TFSA, it doesn't hurt your limit, it actually will increase your limit. There is a method called a growth stock contribution room hack. Now, what you need to do this is you need to be at your limit. And what you're going to then do is you're going to look at perhaps an underperforming dividend stock that you currently have in your TFSA. And you could then sell that stock and buy a growth stock and allow that growth stock to grow and basically expand your contribution room. So it's a little bit of a hack to get yourself some extra space. After you've had adequate growth, you could then sell that growth stock, turn it back into dividend stocks. So it's a neat little way that you can sort of work with dividends and growth stocks to try to maximize your room within your TFSA. However, let me give you this caution. You don't want to be day trading. When I say sell off, an underperforming dividend stock, you're probably going to need to keep this growth stock for, I would say, 35 to 45 days just to be safe before you sell it and then move back into another dividend stock, because you don't want the CRA coming down on you for day trading within your TFSA. So this is a slower process, but it is a neat little way that you can get some extra contribution room. Now with the RRSP, this is great for your foreign dividend stocks. And the reason for that is, and we'll use the US as an example, the US of course does not recognize the TFSA as a registered account. It only recognizes the RRSP. So if you have an American dividend stock in your TFSA, on all of the dividends you receive, you're going to be paying withholding tax. That's not the case in your RRSP. So any foreign dividend stocks, they can just grow, their dividends will continue to grow, and you're not going to be paying any taxes on those. The other great thing about your RRSP is it is a tool for mitigating taxes. Now, the Gen X's should be in those times when they're making some of their biggest amounts of money they're going to make in their entire life. And you have a couple of choices with that money. You can either pay taxes or you can start putting some of it into your RRSP so that you can then generate some tax credits. which will protect you from paying much taxes. Because basically this income that you put into your RRSP, what you're basically doing is you're deferring your taxes to after you retire, when you should be making significantly less, and that should be putting you into a lower tax bracket, so you end up paying less taxes overall. So your RRSP, it becomes a tool in that way, a tool that you can use, well, just to not pay as much taxes as everybody does. Now, with Gen X, crypto is it's a much more attractive investment than it was for the boomers. Crypto definitely should be a part of a well-diversified portfolio. And of course, how much crypto should we have? We're looking at about 5 to 10% of your overall portfolio. Now, there will be people who only invest in crypto. That is a legitimate way to go, but you want to be very careful and you want to make sure you're fully diversified within crypto. And we're going to talk a little bit about that as we sort of break this down within the 5 to 10%, but they're going to be doing it with their whole thing if they're only investing in crypto. I don't advise only investing in crypto, only for the simple reason that full diversification requires a lot more than just just your cryptocurrencies. So you definitely want to have just a general good securities right across the board. So you want to invest in high utility coins. So what I mean by a high utility coin is a coin that, well, it has a function. If you look at the white paper, and anytime you invest in a coin, you really should examine the white paper, make sure that that coin has a function. So for example, if you look at Bitcoin and Ethereum, Bitcoin, it is a store of value. That is its main function. It can be used if you take a layer 2 protocol, for example, Lightning, put it on top of Bitcoin. It can be used as a mode of transaction that way. As for Ethereum, if you look at the NFTs, most NFTs are built on the Ethereum network. So Ethereum has become sort of a backbone for NFTs. When you're just simply looking at it for investing, it is a great option as well as Bitcoin. There are other coins as well, like Polkadot, Solana, Cardano. They all have functioning smart contracts. In the case of Polkadot, it acts as a level 0 coin, meaning that it does allow communication between different cryptocurrencies through something called a Polka bridge. And we'll get into that in a future video. There's also Litecoin, Chainlink, Matic. So these are coins that do have a function. They have high utility. A coin that doesn't have high utility would be, well, a meme coin, for example. So when you look at a meme coin like Dogecoin, although Dogecoin is kind of an interesting case because I think Elon Musk is convinced he wants that coin to have utility, and it may eventually evolve into it, but for most meme coins, there's absolutely no utility. They're pretty much jump in, invest, and get out. So in and out nice and quickly, make some money, but they can be dangerous and they're not something you want to look at for a long-term investment. Swing trading. Swing trading is another option within Gen X. I certainly do a little bit of it myself. So when it comes to swing trading, you want to limit swing trading to what you are willing to lose. So just to be clear, a swing trade is basically, it's a short-term trade. You're jumping in, you're buying something, you're letting it go up in value, and then you're selling it. It's a little bit like day trading, but it doesn't happen in a single day. Sometimes you may have a month-long swing trade. So you definitely want to limit your swing trading to what you are willing to lose because it can be risky. A lot of times you're looking at low-cap coins that are moving or low-cap stocks that are moving quickly, and you're trying to get in, grab some of that extra money and get right back out. So you want to be careful with swing trading. So you need to have a clear strategy when it comes to swing trading. And by that, I mean you need to know when you're getting out. You don't want to allow yourselves to become the victim of FOMO or FUD. FOMO being the fear of missing out. FUD is fear, uncertainty, and doubt. So for example, if an asset's climbing, you probably may not want to jump in. You're going to say, oh my God, I'm missing out on all this profit. I gotta jump in. But a lot of times if you jump in when something's on the rise, you're jumping in too late, especially when we're talking about low cap swing trade type situations. So you may be a situation where you jump in and then it drops. At that point, you've missed out and you've lost money. Now, if it is a stock that's in a channel, meaning that it's clearly going up and down, up and down, up and down. Once you've jumped in on FOMO at the top, the worst thing you can do is, as it fell down on you, is then give in to fear, uncertainty, and doubt and sell it at the bottom of that channel. If it's in a channel like that, you're just going to ride it out at that point. You'll just ride it out until it goes back up. But have a clear strategy before you even get into a swing trading situation. So in a channel, your strategy could be to buy at the bottom of the channel and then sell it at the top. Because if it's clearly moving between two support, like a support, if it's clearly moving in a channel between a support and a resistance, it gives you a good idea of when you can get in and get out. In some cases, if you are afraid that you'll be caught up in the FOMO as you're heading towards the top, you could always set up a limit sell to sort of protect yourself that way. But have a clear strategy. Also, take profits. There is nothing wrong with taking profit. In a situation like this, if you get up towards the top and you make a nice little amount of money, some people will actually take out their initial capital and then just play with the profits that they made on the next movement in the channel. When it comes to hosting your investments, one of my favorites is definitely Wealthsimple. Wealthsimple is commission free on all of your trades. The only other broker that I'm aware of in Canada that's commission free is National Bank, but they will still hit you with the service fees. Wealthsimple doesn't have those either. Wealthsimple is also coming out with Wealthsimple Plus. It's $10 a month to be in it, but it will allow you to have a USD account, and then you can trade within that commission free. So that's going to be a game changer. So definitely they are one of the best to use. On the crypto side, we of course have ShakePay. It's a very easy to use on-ramp for buying your Bitcoin. You can also buy Ethereum, but usually I will buy Bitcoin on it and then I'll move that Bitcoin to one of my exchanges. There's also lots of free Satoshi. So with ShakePay, you can shake every day to earn some free Satoshi. And via their cash card, you can also earn a lot of Satoshi. Right now it's 2% cash back. There are some bonuses over the holidays where you can get it up to 4%. So definitely worth checking out. I have both of these in my affiliate links down below. If you already do have Wealthsimple, I do have my code right up there, but just use that code for 2 free stocks on Wealthsimple Trade. So if you like this content, definitely click on the like button down below. While you're there, click on subscribe and hit that little notification bell. That way there you know when I have a brand new video up and ready for you. If you missed Generational Investing, the Boomers, I'm going to put that right over there for you. So give that a click and have a watch on that. Thank you for watching my video, and we'll see you in the next one.